The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
One of the first questions we frequently get when speaking with somebody after they find out we are money managers is, where's the market going? Or is NVIDIA too high? What about the problems that Apple has in China? What's going to happen there? Everybody wants to know the future. We don't want to throw some cold water on this question, but the fact is the future is unknowable. Let's deal with reality here.
And the sad part is we can't seem to believe it. That's what we're going to talk about a little bit today, is that even though we know we're no good at that, and we've talked about forecasting multiple times here on the Investor Resources Podcast, talking about how wrong we are. The data that I just ran across, I was a little surprised at how wrong we are. And that if we're that far off, why do we bother with this? But on average, a survey of professional forecasters since 1968, so this is a long-running bit of data. The experts making the predictions figure they have about a 53% confidence level in the predictions they're making. So they think they're going to be right at least half the time, and it turns out they're right less than a quarter of the time. So at 23% correct, so they're pushing 80% wrong here. Why does this persist? It's just startling how much we need forecasts and how much we're willing to take them seriously when there's just almost nothing there. And yet, if you turn on any cable financial station, it's one forecast after another all day and all night, and they're almost useless.
My day starts early because I'm normally in front of the computer shortly after 4 o'clock in the morning Pacific time,
right?
Because I'm getting ready for my daily email that goes out. So I'm listening to Marie Bartiromo on Fox Business, and she interviews a lot of people. And the first question out of her mouth almost every time is, well, this stock did this, and where do you think it's going to go now? Or
where are we heading?
The market sold off yesterday, and where are you putting your money? What should our customers, our viewers here be doing with theirs? It's always, this is where we are. You tell us where we're supposed to be tomorrow with this particular subject that she's happened to cover. And I used to watch CNBC in the morning, but they would do the same thing. They just have longer interviews. They have a guest on for an hour, but they're still peppering him or her with, where is this going? What is this going to be? What should we be doing? We need an answer for our viewers. We understand that doesn't work. There is absolutely no predictability to the market. It is a random event. In fact, when ChatGPT came out, there was a massive effort from millions of people to use it to build a portfolio and forecast where they should have their money invested. And the response was from ChatGPT, this is too unpredictable. There's no way to build a model.
But did that slow anything down? No, it did not. The predictions keep rolling in, and from the financial cable news folks, that is just simply a symptom of giving us what we want. We require those as investors. We want to believe that there's some order out there. We want to believe that someone knows something about where we're going, and we want to hear about it. And we're going to take that to heart, and that lets us stay invested. Oh, somebody's got this figured out. And it's just not the case. That same study from 1968 found that all of these prognosticators, if they had 100% confidence in their forecast, if they were 100% sure they were correct, they were still wrong a third of the time. So their question in the data was, can you imagine how much damage you're going to do to your own portfolio if you're acting on 100% confidence and a third of the time you're still completely wrong? It's a train wreck. It's you're never gonna get yourself unburied from those kinds of huge mistakes, which is one of the reasons we're doing this podcast. People really need to understand it's not just that we're bad at predictions, we're terrible. And the outcomes are terrible, and people only do it because that's what we want to hear. So they're just out there shoveling it as fast as they can in our face because we want it. And until that changes, they're not going to stop shoveling it because that's what drives ratings, clicks, views, subscriptions to newsletters, somebody who's willing to get out there and forecast, forecast, forecast. And if you're wrong right now, it doesn't even matter. Like we said, we've said many times, there are plenty of people in the world of finance famous for being right one time. All you have to be is right one time, and you make a huge splash, and people will subscribe to your channel or your newsletter for the rest of your life, hoping you're going to be right again at some point. And the odds are very much against that. And we're just saying, make sure you understand that the odds are not just stacked against you; they're so bad that if you took one step back and looked at it, you would never follow them at all.
Well, that's one of the reasons that modern portfolio theory models are popular. One, they're
Yeah.
easy to understand. They're easy to graphically explain to somebody who doesn't have a financial background. They look pretty when you print them out, but they
Yep.
basically say, we don't know what's going to go on, so we're going to buy a whole bunch of stuff. Diversification is important, and we will just go with the flow with periodic rebalancing, whether it's quarterly, semi-annual, or annually. That's just what we're going to do because we don't have a clue. That when you use an
Yeah.
MPT model, that's basically what you're admitting to. My
Yep.
advisor has no clue, has no strategy. This is just the default way to handle the unknown. We
Right.
also know that when bad things happen, and they have in the past, they will again. And in
Yep.
those times, clients get upset because they thought they had management when they basically had a buy and hold through hell and high water. And when we figured out that that's what those models are, don't give a rip about what's happening in the market. Just wait for your 10 or 20 or 30 years for it to work out. We said,
Right.
let's go back to some basics that happened before MPT, modern portfolio theory, was created out of thin air by a man who says the industry uses my models incorrectly. They're never designed to be used this way. Let's go back
Right.
and look at how money was actually managed prior to that event in the 1950s. And that was basically, where's leadership? Where is money going in the market that's driving prices higher? And if money is being attracted, now I would refer to it, you own an asset that's a magnet for money. Investors have faith in this particular asset, this sector, this industry. They're dumping money into it. There's a demand and prices rise. You want to own that stuff. When investors say, man, this industry's in trouble, this sector stinks, I'm selling my shares and getting out while the getting's good or saving what's left of it. You don't want those in your portfolio. And the typical
Correct.
client hangs on to them because that's the way the model works. You hang on through hell and high water. You ignore the bad news, and the advisor's job is to hold your hand and tell you, don't worry, this is going to work out. You know, just stay with me, and over time it's going to work out. Keep the faith. Look, this started in the 50s. We're still doing it. We're still doing it even though it has all these problems attached to it. And there's no academic support for actually using the model the way it is today. So what do
And
we
that's
do?
what you have to remember too about MPT. Let me get this end on is that MPT is 100% forecast based. All they do, historically based forecasts, all they do is look backwards and say, well, this is what did happen, so we're going to predict that same thing's going to happen again in the future, and we're just going to model everything based on what's already gone by, even though they're required by law to print a disclaimer on all their paperwork saying, oh, by the way, past performance, no guarantee of future return. But that's what MPT is based on. past performance, nothing else. It's just historical returns. And then we're going to just look at those into the future and pretend it's going to happen again. So if you're just sitting there in a 60/40 portfolio, you're making a forecast. Stocks are going to be better than bonds because we're going to have 60% of them versus the bonds. And over exceedingly long periods of time, we think that'll work out. It's just another forecast. It's just another forecast. Everything's going to be the same as it always has been. And it makes no sense. There's no academic underpinnings that say it's accurate, true, or even useful. And like I said, Harry Markowitz, the guy that wrote MPT, said, you guys are using this all wrong. And never forget, he wrote it when? As a college student, prior to any investing experience at all. It was a math exercise. And the math is very elegant. In fact, the math works. It just can't be applied to a chaotic market like the stock market or the bond market.
Well, when Harry Markowitz retired, he was asked, "You're going to use this model for your own retirement money?" He said, "No, I'm not going to do that." So
I've seen
there's
it
the
work.
reliability
Yeah.
factor.
No, not my money.
So once we figured out that was a serious flaw in those models, as I said a moment ago, we need to go back and look and see how money managers managed market risk prior to the implementation of modern portfolio theory.
Correct.
And basically what they did is they looked for winners and they invested in winners. And when those winners lost their leadership, they'd sell them. If they had something that they bought that didn't work out, they didn't hang on to it. They got rid of it. Now, there were fewer things to invest in back in the 30s, 40s, and 50s. The math was still the math that's used today to figure out corporate earnings versus stock price valuations. And
Yep.
there's multiple ways to do that. So you can have an opinion that one process is more valid than another. But then again, somebody else will use a different process and disagree with you. Some people think today's stock market is overvalued. Others say, given current corporate earnings, it's not overvalued. It is high, and it may be on a higher end, but it certainly is not in a historical reference overvalued, ready for another bear market. So
Correct.
you want to flip a coin, take your choice. Which process of evaluation you want to use. We decided we just simply use the standard process of following leadership. If we own leaders in the portfolio, we're going to capture the bulk of that gain. When they quit leading, we take them out of the portfolio. In the business, it's referred to as momentum or trend following. We don't forecast because, as we said at the beginning, there is no forecast that's accurate. You can flip
None.
a coin. You want the market to be higher tomorrow? Yes, flip a coin. Heads or tails. We'll tell you whether it's likely to be or not. It's as good a chance as anything else. Even some of the AI software that I have today, it is over a period of time, it's 85 or 86% accurate. But on a day-to-day basis, there are times when it's absolutely wrong. It forecasts the market, the major index is going to be down and the index is up. And it takes a couple of days for the iteration to work its way into a new calculation. So,
Which is why we don't day trade. We're not talking about getting in and out of things every 2 or 3 days. We're looking at larger trends, more following the money, more money in and out of the market, and so it needs to be significant moves in larger positions, and not the day-to-day stuff, because that really truly is just noise. And all of the financial media is required to be on 24 hours a day. So that's what they're going to talk about. That doesn't mean there's any value there, no matter how compelling they make it sound, because that pie chart model, that's just a sales pitch. There's no investing smarts that makes any sense. It's just a great sales pitch. And until it's completely walked away from, Wall Street's going to keep selling it as long as somebody keeps buying it. And we're trying to do our part to move that to the side.
so one of the reasons the financial press that continues to do this is because their job is to sell advertising. I mean,
Correct.
why do you run a television network? To sell advertising.
Yep.
The public thinks that you're trying to educate them, but that's not true. All we're trying to do is create concern so that you will be available to watch all the ads we're going to run through for you to observe. That's one of the things that I love about a DVR because most of
Bingo.
our most of our entertainment TV at home is pre-recorded so that we can skim through those 3-minute serial ads and get back to the program we want to watch.
There you go. It's a
One of
wonderful
the other
feature.
one of the other areas of forecasting that has been popular for years, and certainly in the financial services industry, is magazine covers.
Sure.
Magazine cover has basically been viewed as a contrarian signal. When the market says this is about to collapse or now's a good time to buy, that's usually backwards because the magazine has taken a year to reach a conclusion that savvy investors started piling into that particular investment or leaving it a year ago. And
Right.
finally, it's a big enough trend that the press has recognized it and they put it on the front cover.
We could put it on the
But
cover. Right.
but the bottom line is it's random. Just like the other forecast, there's no certainty that a magazine cover should be used as a predictive tool on your portfolio. Every now and then, one of them is going to be right, but
And they
do
can be
not.
fun to follow. They're cool to see, but don't make any portfolio decisions based on those. It's not a reliable indicator for a real investing.
So if you want to talk to us about how we look at the current market and portfolio structure, give us a call, send us an email. We'll give you a free analysis from our perspective of what's in your portfolio. Does it make sense to continue holding it? Should you have already sold it? Or is there a warning sign that you should be paying close attention to it? Do you own magnets for money, or are you on the wrong side of the attraction equation and it's actually repelling? You've got two ends that don't go together and they're forcing it apart, in which case you're subject to potential losses. That's a free analysis. All you need to do is give us a call, send us an email. We don't need to see your portfolio balance. We just need to talk about what you own. What are the tickers? And we'll be glad to do that. And our phone number, our email are on this next slide. Give us a call, contact us. If this is your first time on the podcast, subscribe to it. We do a week in review published on the first day of the week. We need your email. If you want to do that, send us an email and tell us you want to be on the weekend review or the weekly update, and we'll be glad to add you to that. It's a freebie. If you don't like it, easy to unsubscribe. You never hear from us again. But we get very few unsubscribes. It just has not happened very often. It's worthwhile information. Have a great day. Look forward to the next time around.